Hi, my name's Ken. Thanks for joining me. The purpose of today's webinar is to give you a little bit about my background, why most people's experience with financial advisors are fraught with high fees, conflicts of interest, lack of transparency, cookie cutter advice, overpromising, and how to prevent those unpleasant experiences with our three most popular services: You Grew Stocks, You Grew Income, and You Grew Wealth, which should take about 30 minutes. If what I share resonates with you, then let's meet. If you haven't already scheduled time with me, I'll share a link you can schedule at the end of this presentation for a retirement checkup. The retirement checkup is a 20 to 30-minute meeting for data gathering so we can get to know you and discover if we can add value to your financial future. Once complete, we'll schedule a strategy session to determine the best path forward for you. Both Zoom meetings are free and to the point, so there won't be any time wasted. Speaking of wasting time, let me dive right in. I've been a financial professional for nearly 30 years. I left Merrill Lynch in 2006 to start a registered investment advisory practice, which acts as a fiduciary for their clients, and why that doesn't matter as much as you may think. I have a long list of career accomplishments, but the one that most matters, in my humble opinion, is that I've been a student of personal finance, without which I would not have created the tools and services that add value in the absence of stock market return while sidestepping major market crashes like the one in 2008 and a very different crash that is upon us I wrote in my most recent book. This has uniquely positioned me to help you in ways most other professionals can't, even if they wanted. Now, I know that's a bold statement, so stick with me and you'll understand what I mean as I dive in with some basics. The most important part of investing is knowing when to enter and exit an investment. You've heard it and probably said it yourself: buy low and sell high. But statistically, that doesn't happen. And it all starts with one word. Before I share that word, let me ask you three questions. If you purchased a house, would you say you invested in real estate? If you bought shares of Google, would you say you invested in stocks? And if you invested in Bitcoin, would you say you invested in crypto? Whether you know it or not, you're investing in probability. And understanding this one word and what it means when it comes to your investments will determine your success. The challenge is most people really don't know whether their purchase has a higher probability of going up or down. This is because their decisions are typically based on emotion, where optimism is taken over by greed, euphoria, then fear, and eventually capitulation. And this process is recycled over a lifetime. And because of that, they experience an incredibly low rate of return of 2% average. Inside of those emotional cycles, they make their decisions typically based on three things: if the charts are going up or down, how popular the brand is, and if they buy that product themselves. All of these make for incredibly unsuccessful investing. Take point number one: investing because a chart looks like it has a history of going up. When people look at charts, what they're seeing is the past, and that's like driving down the road using only your rearview mirror. This is what's called a trailing indicator, which is the same outdated information that you get from the news, rumors at the office, or a YouTube video. Investors usually don't know what they're looking at, so they turn to the garden variety financial professional whose all in costs are more than 1.5% per year. And that's even if you're a millionaire. What you're seeing here is FINRA's Fund Analyzer. FINRA is the regulatory body overseeing financial advisors, and they created this calculator so that you can discover what you might be paying on your managed assets. You may not know this, but almost all financial advisors are merely salespeople. They're compensated for selling you on where to invest your money while someone else is managing the day to day selection of the stocks and bonds in your portfolio. I've chosen three popular funds that advisors like to place your money in. I've selected an investment amount of $150,000, earning an average rate of 9% per year over 20 years. These funds have annual operating expenses ranging from $56,000 to $82,000 over the 20-year period that we're showing. Playing devil's advocate, you might think, well, Ken, that's okay because I'm paying the professional to beat the market. Let's find out. You can see the 10-year returns range between 10 and 11%. But if we were to simply place the same $150,000 in an ETF like the Q's or Vanguard's S&P 500 fund, the 10-year performance is 12% to over 17%. The cumulative fees over the same 20 years for the ETFs is between $2,000 and $15,000. But fund fees are only part of the issue. The problem is compounded with advisor fees. If $150,000 grows at 9% per year over 20 years, the balance will be $840,000. But subtract a 1.5% advisor fee, and you're not earning 9%, you're earning 7.5%, reducing the 20-year ending balance to $637,000. Add in the average fund fees, and the cost soars to nearly $270,000. Now, we don't know each other very well yet, but I assume if I suggested I would charge you $270,000, you'd have left the meeting by now. Still, yet, some of you may believe the advisor can time the market. Some advisors are smart enough to do that, but it's likely to never happen because of something called the Know Your Client rule. Part of that process is taking you through a profile test, which asks you a simple question like, if the market dropped by 20%, would you A, take your money and run, B, do nothing, or C, invest more? Every other question in this test is substantially similar. What they're trying to do is gauge your risk tolerance by scoring you to establish how they should allocate your portfolio. So, if you scored as a growth and income investor, your portfolio might look like this. Now, the problem with that is that now you expect, and the advisor is expected to keep you allocated in that same percentage, so you don't have to worry about your money being reallocated to some hyper aggressive or conservative position. So, even if the advisor is smart enough to know that we're expecting a 30% drawdown in stocks, they're not agile enough to make those decisions. This is not only important, but it's critical. Why? Because it happens every other year. Let's forget about fees for a minute and do some simple math. If we invest $100,000 and the market corrects by 10%, we're left with $90,000. But getting a 10% return the next year doesn't make us whole. If we had the tools to mitigate a large part of those losses, we would preserve more money, and even if we underperform the markets on the rebound, we're still $7,000 better off. Play this out 6 times over 20 years, throw in a couple 30% and 50% drawdowns, and the difference in performance is staggering. It's far easier for the professionals to gaslight us, which is why you may have heard excuses like, well, the market was down 30%, but you were only down 27%, so we outperformed the market by 3%. Or maybe they say it's only a loss if you sell. They make it sound like a new discovery, but I've been seeing this on the news for a quarter of a century, and I'm sure you've heard at some point that 80% of fund managers fail to beat the market. It's not because they're incapable, but because of the profile the SEC wants, and your attorney making the promise to reinforce it. Put simply, it's likely because you're in a box. So, what can we do? Well, the first thing is to understand where the fiduciary responsibility starts and stops with investment advisors. And it starts by the way they're paid. They're compensated based on the amount of assets they have under management, which incentivizes them to sell you on their service. Put you in a box based on your profile, outsource the heavy lifting so they can move on to sell the next person willing to invest in them. The sad part is that most Americans are being seriously held back by this rinse and repeat process, and they're looking for answers, but are finding themselves corralled in a few options. You can underperform with an advisor, take all the risk on individual stocks like Tesla, which I'll talk about in a few minutes, or you can simply throw your money in one of the indexes. But you cannot enjoy the performance of private equity, venture capital, or hedge funds because 90% of Americans aren't accredited investors, which means you must have $1 million or more or an income of $200,000 per year or more. The stock market makes all the headlines and excites people, but private equity has quietly outperformed the S&P 500 over the past 5, 10, 15, and 20-year periods. Now, the difference of 5% over 20 years may not sound like a lot, but let's find out. And I'd like you to watch the next few minutes asking yourself whether the accredited investor rules are about sophistication or discrimination. So let's start with our $150,000 again, invested over 20 years at 9.7%. What would we have? Well, we'd have just shy of $1 million. Now, that same $150,000 over 20 years at 15.2% is $2.5 million. Let that sink in for just a second and ask yourself what good reason is there that the masses don't have access to this? The point is that there is an obvious class war going on that most don't recognize. And behind the scenes efforts have fallen on deaf ears for decades. But we have several answers. beginning with our Uger stock service and what drives the impressive results many clients are already enjoying, starting with a little background. As a professional investment advisor, I used what's called a top down strategy to select my client portfolio. I've always told people I have a crystal ball, but it's been broken for a long time because no one can predict the markets perfectly. But there are things that we have real and concrete data on, like the spending habits of people. So I would first look at a global macro view and the main driver of any economy, which is procreation. And multi billion dollar corporations spend billions trying to figure out every new person's spending habits. They do this through marketing and big data. The more they know about you, the more they know how to position themselves to get you to do one simple thing: part with your money. Years of this data tells us that earning and spending increases from your 20s to 30s and peaks in your 40s before it starts its decline. This is important for us to know because markets are driven in part by velocity. The faster and more money that is spent on goods and services, the more upward pressure that has on the stock market as a whole. And if we know when a society is at its peak earning and spending age, then, well, we have a great idea of broad market movements. For example, if we look at population growth like the baby boomers, we know that everything they've touched has turned to gold. As this generation aged, companies like Gerber, Mattel, McDonald's, more recently the computer industry, financial services, then healthcare in their old age and beyond. Why? Because there were 76 million of them born between the years of 1946 and 1964, more than any generation before or since. Now, if we adjust for the added immigration and move the chart forward representing the peak earning and spending years of this generation, you can see how it aligns with the Dow Jones adjusted for inflation. The implications of population trends are important and give us a leading indicator of the markets, which is why we focus many of our stocks on this type of movement. Not so much the people and age, but what the people are buying. Just like Gerber, Mattel, McDonald's, and others had their golden era, well, so will other ideas and technologies. And something that's exacerbated the economic power of the boomer generation is that we've enjoyed a depreciating cycle for 40 years. For example, in 1981, mortgage rates peaked at over 18%, and the masses that bought homes in that period at $80,000, for example, sold a handful of years later for $115,000. After expenses, they pocketed, say, $40,000, used $15,000 on a down payment for a larger $150,000 home at a far lower 8%, making their new payment similar to the previous mortgage. So they were able to keep their same budget, but now had $25,000 of discretionary funds to buy cars, furniture, and stocks. This repeat cycle over 40 years created the velocity effect that I shared earlier and made for easy markets where you could blindly throw money in an S&P 500 ETF, forget about it, and be happy years later. Today, we're experiencing a tectonic shift in the economy and investing won't be as easy as it used to be because now we have to worry about two different kinds of market crashes. Most of us understand a market crash as stocks tumbling down 20, 30, or 50%, but we are at just as much risk of crashing up. Crashing up means that we're nominally getting great returns in the market, like 9% average, but inflation averages 9.5% over the same period. So our nominal return is 9%, but our real return is actually a loss of a half a percent. We're stepping into a new era, and I want to put this into perspective for you. This is Fifth Avenue, New York City in the year 1900. Where is the combustion automobile? You can see it here surrounded by horse drawn carriages and buggies. We had stepped into a new era in 1900, and it only took 13 short years and 100 automakers later for the same place, Fifth Avenue, New York City, to ask the complete opposite question: where's the horse? History repeats itself, or rhymes as Mark Twain says, every 10 years or so. We have a new era that kicks off. 1986, Microsoft kicked off the era of personal computing with its initial public offering. 1997, Amazon kicked off a new era for the way we consumed goods and services. 2004, Google kicked off the new era of big data and the Internet of Things. Facebook kicked off the social media era with its IPO in 2012, and Coinbase just kicked off mass adoption with the crypto era. And nothing will be the same when it comes to money transfer, contracts, fund settlement, and a host of other areas of finance. We want new era stocks so we have the wind at our back, But we need to know the best entry and exit points because population and market trends only gives us a rough idea of where the markets are moving, and it could be off by more than 5 years or manipulated by things like quantitative easing. So another leading indicator would be oil. Oil is a precious resource, and there is a finite supply of it. At least that's what geophysicist Marion King Hubbard's peak oil theory states. The truth is that the world renews its oil, but we've been consuming it at a faster pace than it can reproduce, meaning it requires more effort and more money to produce the same barrel of oil, which has an economic impact. Of course, he knew this and stated that it's hard to know which is more remarkable, that it took 600 million years for the Earth to make its oil, or that it took 300 years to use it up. If everything the boomers touch turned to gold, then everything we use is touched by oil, from the shirt on your back to the ever popular electric vehicle. Because of this, oil can be a great leading indicator and dial in the accuracy of market movements from 12 to 18 months. Because history tells us if oil grows, the price per barrel, that is, 100% year over year, the markets will be down greater than 20% 12 to 18 months later. I've seen this play out time and again, and I've used the contrapositive nature between oil and the markets to help save my clients from losing half of their life savings as far back as 2001. After oil, I'd look to the almanac. Just like the Farmer's Almanac, there's a stock trader's almanac released every year. This gives interesting insight into all kinds of events that might indicate market movements. But what I find most helpful is sector seasonality, otherwise known as sector rotation. If global macro and oil pricing help me determine how much to allocate to stocks, bonds, and cash, well then, sector rotation helped me determine what percentage of equities were allocated to biotech, financials, healthcare, etc. This would help me dial in my time frames to less than a year. And then there are the technical indicators. There are many more than this that should be considered, but as an idea, I would look at the relative strength index, the PEG ratio, and the moving averages. When the technicals had consensus, this helped me identify best of breed and best entry and exit points, which would then make the final cut, and dial in my time frames to days. It used to take 12-hour days for a month each year to determine all of this, but now this same criteria has been bottled up to save massive amounts of time. And Uyghur Stocks unbottles all this published performance for you to enjoy, requiring only 5 minutes of your time per month. Not only have we crushed the markets, but following the alerts has beat even a buy and hold strategy on individual stocks like Tesla. Had you bought Tesla and held it August of 2022 to September 2024, you'd be down over 7% versus a gain of 170% using Uyghur Stocks. Uyghur Stocks doesn't have to be where you place all your money, and it shouldn't be. But think about this. If you fired your advisor who benchmarked your $100,000 portfolio on the S&P 500 and instead placed 90% in an S&P 500 index fund and used 10% to follow Tesla alerts, not only would you have saved $146 a month in fees, but you'd also have almost $24,000 more in gains. Or if you're retired and worried about inflation, 90% could buy a 5% bond and give you $4,500 in dividends per year, and your holdings would be $124,000, an annual increase of almost 10% after dividend income while you outpaced inflation. The beauty is, you don't need $150,000. If you started with $5,000 and experienced one of our mid-performing stocks, Advanced Micro Devices, you'd be up over 87% from October 2023 to September 2024. That's $5,000 growing to $9,400 in one short year. These are just simple thoughts and ideas, and there are more powerful strategies and processes that you can take advantage of by us helping you with Retirement Destinations, our powerful and proprietary financial planning software. Retirement Destinations was so well built, it was in the top 10 of over 500 global competitors for the Cloud Awards, and we're grateful to have this capability to serve our clients with it. By offering our most robust service, Uyghur Wealth, and our most popular service, Uyghur Income. Depending on your situation, Uyghur Wealth can add hundreds of thousands of dollars or more in your retirement through category iterative planning. This is a step-by-step process with our proprietary planning software that looks at one area of your finances, tests multiple iterations to identify which has the biggest positive financial impact, then moves on to the next category, and so on. That process starts with logging into your personal planning portal, where we complete what we call a pre-client plan. This models your current financial state. Everyone has their own financial fingerprint, so this plan is a personalized plan that takes a snapshot of your current holdings and runs that to end of life with a focus on whether you have a shortfall, and if so, to what extent. As we complete each iteration, you will see the previous plans that were improved upon and how much value you're seeing from each. Basically, we're identifying inefficiencies in current financial decisions in every area of your finances to grow your wealth without relying on stock market performance. Once your final plan is complete, we handhold you through the process of executing every element of the plan. In other words, control what you can with all your financial decisions first. Then, and only then, focus on managing the things you don't have definitive control over, like the stock market. Our most popular service is UGRU Income. UGRU Income is essentially an income optimization analysis. What investment types and accounts we choose to have in the distribution phase of our lives during retirement is critical, and the UGRU Income process answers this complex question in a crystal clear way. First, we complete a personalized comparison of every type of investment vehicle you can possibly choose with safety, longevity, fees, and growth in mind. Just like UGRU Wealth, we let the numbers drive the decisions here. Then we test the optimal distribution order. In other words, what account should you use first to fund your retirement that your Social Security or pension falls short on, then the next account, and so on. What you're seeing here is a real client, and the results you see here for UGRU Income are typical. It may be a little small, but in the original snapshot plan, they had a shortfall of $461,000 that pension and Social Security failed to fund in their retirement. And just like the UGRU Wealth Service, the value added that you see here is not from pretending that you can experience better market returns in one scenario versus the other. Each scenario assumes you experience the same exact markets. We believe this is a tremendous value. If you can eradicate hundreds of thousands in retirement shortfall by simply knowing the best places to put your money and the most optimal order to distribute regardless of market fluctuations, then it's a no-brainer. But the point I want to leave you with is this. Money is not a spectator sport. You only guarantee that you lose by abdicating the duties to monitor in your youth what will care for you in your old age. So I'd encourage you to take the next step and visit us in a retirement checkup. Purpose of the meeting is to complete a financial checkup for you to identify where you're excelling and where you might need improvements, kind of like checking your vitals at the doctor. This is where we calculate your desired monthly income in retirement using what's called a capital value calculation. This tells you the total savings needed to give you the after-tax and inflation-adjusted income that you desire without exhausting that retirement nest egg. We then calculate the future capital value based on your current financial state, including everything you've saved to this point, your current monthly savings, investment property, future Social Security income, and pensions. Then we deduct the capital value of everything in step 2 from the capital value as calculated in step 1. This will reflect whether you're on track for retirement or not. Finally, we calculate how much additional you need to save on a monthly basis starting today to close the gap, if needed. If you do have a shortfall, the alternative is usually retire later, work at Walmart in retirement, live on less, allocate your portfolio more aggressively, or come out of pocket each month. But we have a solid track record of mitigating any additional savings otherwise needed through our UGRU Income and UGRU Wealth process. Whether you have a shortfall, want to retire earlier, or optimize your current retirement, and you like our process, we can find a time that works for both of us to determine what the next steps look like. Remember, the next 2 meetings are free. So if you want to sidestep the high fees, conflicts of interest, lack of transparency, cookie cutter advice, overpromising, and experience serious savings, aligned interests, transparency, tailored planning, and clear expectations, well then, be sure to schedule your retirement checkup now if you haven't already. Thank you for joining me. I enjoyed myself. I hope you did too. I'm looking forward to you joining a growing number of people who have a newfound confidence in their financial future. Until then, wishing you and your family all the best.